Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate mumbo jumbo. And in today's report, we're diving into the Fidelity Solana Fund's 10Q report, an in-depth look at a digital asset fund. And trust me, there are some really interesting things happening here, especially for a fund that is just getting started. Before we dive too deep into the numbers though, if you are like me and you appreciate getting straight to the point insights from these dense corporate documents, make sure you hit that subscribe button and ring the bell. We also have a fantastic Discord community where we break down these filings and discuss them. Further links are in the description below. So what exactly are we looking at here? It is a quarterly report from the Fidelity Solana Fund. Essentially, this fund is designed to track the performance of Solana, a popular digital asset. The kicker is this fund is still very new. Its seeding date was the 10th of September 2025. So we are talking about the very first bits of its operational life. Let's get straight into the heart of it, the financial statements. For the period ending the 30th of September 2025, the fund's total assets were listed at just over $4.8 million. Now that sounds like a lot, but this is essentially the initial investment into Solana itself. The report highlights an investment in Solana at fair value of the same amount. Interestingly, their cost for this investment was $5 million. This means right out of the gate there was an unrealized loss or depreciation of about $161,939. This is not uncommon with volatile assets like digital currencies, especially in their initial phase. It shows the market value of Solana had already dipped slightly from when the fund first made its purchase. Looking at the statement of operations for this very short period from the 10th of September to the 30th of September 2025, we see no investment income. This is expected as the fund is just getting off the ground. The expenses are also listed as zero. However, the real story here is the net change in unrealized appreciation. Depreciation on investment in Solana, which is a negative $161,939. This directly translates to the unrealized loss we saw on the balance sheet. So for this initial period, the fund's operations resulted in a net decrease in assets of that same amount. The statement of changes in net assets really paints a picture of how this initially happened. The net decrease from operations was that $161,939, but then we see a significant net decrease in net assets resulting from capital share transactions of $5 million. This is driven by shares issued and shares redeemed. The report shows 5,025,000 shares were issued and only 25 shares were redeemed. This large inflow of capital likely represents the initial seed funding to acquire the Solana. Now let's talk cash flow. For operations, the fund had a net cash used of $5 million. This is primarily due to the purchase of Solana, which was a $5 million outflow. On the financing side, they had a net cash provided of $5 million. This reflects the capital injections to fund that Solana purchase. Interestingly, the fund had no cash at the beginning of the period and zero cash at the end of the period. This makes sense for a fund primarily holding one digital asset. The schedule of investment is where we see the direct holdings. As of the 30th of September, the fund held 23,402 Solana. The cost for this was $5 million and its fair value was $4.838 million. This accounts for 100% of the fund's net assets. This is a very concentrated investment strategy. As expected for a fund specifically designed to track Solana, it means the fund's performance is entirely tied to the price movements of Solana. Digging into the notes, we learn that the fund was formed in March 2025. Its main goal is to track Solana's performance. The sponsor is FD Funds Management LLC, which is part of FMR LLC. The fund had almost no operations before the 24th of September 2025. That is when the initial seed share was bought and then redeemed for a much larger purchase of 200,000 shares at $25 each. That is how they got the initial $5 million to buy the Solana. Here we get into the nitty-gritty of how they value things. They use generally accepted accounting principles, or GAAP, and they're treating this fund as an investment company. That means their investment in Solana is recorded at fair value. They explain the fair value hierarchy, level 1, level 2, level 3, which basically categorizes how reliable the price information is. For Solana, it seems to be categorized under level 1, meaning it is based on quoted prices in active markets. They also mention that the sponsor does not expect to be reimbursed by the trust for initial organizational expenses. Under note 4, we see a breakdown of how their assets are valued. As of the 30th of September 2025, their entire $4.838 million in investments are categorized as level 1. This means they are using readily available market prices for Solana. There are no level 2 or level 3 investments, which would involve more subjective valuations or inputs from less active markets. This further confirms the fund's straightforward approach of holding Solana and valuing it based on current market prices. This section is crucial as it covers what happened after the reporting period. On the 27th of October 2025, they agreed to a sponsor fee of 0.25% of the fund's Solana holdings. They also outlined a staking fee arrangement where 15% of staking rewards would go towards the sponsor and other parties. Then on the 29th of October, a fee waiver agreement was signed where the sponsor agreed to waive the sponsor fee entirely for a period. This was further amended on the 17th of November to also waive staking fees on the first $1 billion of the fund's assets. This is a significant move by the sponsor to reduce initial costs for investors. Moving into management's discussion and analysis, which is basically the sponsor's explanation of what is going on. They reiterate the fund's objective to track Solana's performance, and that it is designed to be a cost-effective way to invest in Solana. They explain how the net asset value, or NAV, is calculated, primarily using the volume-weighted median price of Solana used for the index calculation. They also mention an intraday indicative value, or IIV, which is supposed to give investors a real-time estimate of the NAV, but it is important to remember that the official NAV is calculated only once a day. Interestingly, this section states that the trust is not required to provide the information required by this item in this quarterly report. This is likely due to the fund's early stage and limited complexity. Under controls and procedures, the management confirms that their disclosure controls and procedures are effective. They also state that there have been no changes in internal controls over financial reporting that would materially affect them. This is standard corporate reporting language. This section points us to the prospectus for a full list of risk factors. However, we know from the nature of the fund that the primary risk is the volatility of Solana itself. Any significant drop in Solana's price will directly impact the value of the fund. Here, they detail the initial share issuance. The seed capital investor, FMR Capital Inc., purchased one share for $25 on the 10th of September. Then on the 24th of September, they purchased 200,000 shares for $5 million. This is how they raised the capital to buy the Solana. The exhibits list is quite extensive, detailing all the agreements and documents associated with the fund's formation and operation. This includes things like the trust agreement, custodial service agreements, and importantly, the fee waiver agreement. Now let's wrap this up with my take on the Fidelity Solana fund. This is a very early stage fund, and its financial statements reflect that. The core story here is the initial investment in Solana, the subsequent slight drop in its value resulting in an unrealized loss, and the significant capital infusion from its sponsor to get the ball rolling. The fee waiver agreements are a smart move by Fidelity to attract early investors by reducing the cost burden during this crucial startup phase. The concentration risk is obvious as the fund holds only Solana, so its success is entirely dependent on the performance of that single digital asset. For investors, this means significant potential upside if Solana performs well, but also a substantial downside risk if it doesn't. The fund's reliance on level 1 fair value measurements also indicates a direct link to observable market prices, which can be both a strength for transparency and a weakness given the inherent volatility of digital assets. It will be interesting to watch how this fund navigates the crypto market and whether the fee waivers can sustain investor interest long enough for the fund to gain traction. The primary opportunity lies in offering a regulated and accessible way for traditional investors to gain exposure to Solana, while the main risk is clearly the price volatility of Solana itself. Alright, that is our breakdown of the Fidelity Solana Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.